Okay. Afternoon, everyone. So this week we'll be doing revenue part 2. Last week or the week before your last assessment, you looked at revenue part 1. Okay. So just a reminder that this session is being recorded as well. Okay. So let's have a look at the learning outcomes. So let's have a look at the learning outcomes. So this week we'll be looking at step 4 and step 5. I'm just going to present this. So this week we'll be looking at step 4 and step 5. So step 4, we need to learn how to allocate the transaction price to the performance obligation. And in step 5, we're going to see how to recognize revenue when the performance obligation is satisfied. So under step 5, we're also going to look at how to account for the sale of a warranty. And we're also going to look at principal versus agent concept and how revenue is dealt with for each of these. Then we're also going to look at how to present and disclose revenue in the financial statements. So last week you would have looked at step 1, which was identify the contract, step 2, which was identify the performance obligation, and step 3, determine the transaction price. So let's just have a look at a recap of week 1. So if we look at a recap, so last time you did revenue, you looked at the sale of goods. So there's different types of transactions when we look at revenue. So we'll be looking at sale of goods produced by a company, or a company can resell goods purchased by the company. Maybe they are a retailer and they are purchasing the goods from a manufacturer. We're also going to look at service transactions. And then under revenue, there also can be a multi-element transaction, which consists of both sale of goods and perhaps a service. Okay, so there's more than one type of transaction there. So just a reminder that income is not revenue, okay? So revenue is a subset of income and is from the ordinary activities of a business. There can also be gains which are not from the ordinary activities of a business. An example of this would be profit on sale of PPE. So you'll agree that if a company is selling t-shirts, if they then decide to sell a piece of machinery, this may result in a gain which is not from the ordinary activities. So, for example, also a retailer may earn interest on surplus cash. So, since this interest income is outside of its ordinary activities of buying and selling, this entity would not present this interest income as revenue. Whereas if we are dealing with a bank or a financier and their ordinary activities are to charge interest on loans, then they would present this interest income as revenue. Okay, so it's important to look at the company that we are dealing with and to also, so just to understand what company we are dealing with and whether what we are looking at is part of their ordinary activities. So let's have a look at the steps here, okay? So last week, like I said, you would have looked at how to identify the contract and then identify the performance obligations, and then you would have determined the transaction price. So this week, we'll be looking at how to allocate the transaction price to the performance obligation in the contract, and then we'll also be looking at how to recognize revenue when or as the entity satisfies a performance obligation. So we are continuing with the 5-step approach. Let's have a look at step 4, and this is to allocate the transaction price to the performance obligation in the contract. So there are different bases. So the general principle is to determine the standalone selling price of each performance obligation using an observable price. Then we're going to calculate the total standalone selling price of all performance obligations, and then we're going to allocate the total transaction price to the performance obligations in proportion to the specific standalone selling price, okay? So an exception to this is if the transaction price includes a discount, okay? So we'll look at how to deal with a discount later on. So what is the standalone selling price? This is the price at which an entity would sell a promised good or service separately to a customer. Observable price is the price at which the good or service is sold separately to a similar customer under similar circumstances. Okay, so when we say SSP, that is standalone selling price. So here we have an example. Volkswagen and Maponya Moore sold a second-hand Polo to Skumba Kaya that included a maintenance plan for 2 years. The total value of the sale was 250,000. So below are the standalone selling prices for the vehicle, which was 220,000, and the maintenance plan, which was 50,000. And the required says calculate and discuss how the transaction price will be allocated. So here we have a calculation. Okay? The standalone selling price of 220,000 and we have the maintenance plan of 50,000. So these are the standalone selling prices. Okay, so we're going to total that and that will give us 270,000. So we're going to take the standalone selling prices given to us in the scenario and then we're going to total it. And then we're going to do a calculation where we're going to take the standalone selling price and multiply it by the transaction price. So the transaction price in the scenario was 250,000. So then we're going to allocate the transaction price to each standalone selling price. We're going to allocate it based on that. And then we'll get an allocation of the transaction price, okay? So we do that by taking the standalone selling price of the vehicles, which is 220,000, divided by 270,000, which is the total of the standalone selling prices, multiplied by the 250,000, and that will give us the allocation of the transaction price for the vehicle, which is 203,704 Rand. Then we have the maintenance plan. So the maintenance plan, the standalone selling price is 50,000 divided by the total standalone selling price, which is 270,000, multiplied by 250,000, which is the transaction price. So this then gives us 46,296 Rand, and this is the allocation of the transaction price to the maintenance plan. So in this scenario, we can see that the sale of the vehicle and the maintenance plan, each of those is a separate performance obligation. So we have allocated the transaction price to each performance obligation in the contract based on the standalone selling price. So after we've done the calculation, we can see that VW will recognize revenue of 203,704 Rand when the risks and rewards of ownership of the vehicle are transferred to SK, which is at a point in time. Then the 46,296 Rand will be recognized by VW as revenue over the 2-year period that the maintenance is provided. So because it is a maintenance plan, it is going to be satisfied over time. And we'll look specifically at revenue at a point in time and revenue recognized over time as well. So what happens if there is no observable price? So then we need to estimate the standalone selling price using one of the following methods. So we need to use the adjusted market assessment approach, the expected cost plus margin approach, or the residual approach. So the residual approach is the amount remaining once all the standalone selling price of the other performance obligations have been deducted from the transaction price. If there's only one performance obligation, then it is not necessary to do an allocation. So step 4, which is the step we're looking at, this is always done at the inception of the contract. No reallocation of the transaction price will take place if there are any changes in the standalone selling price after the start of the contract. So here we have the different methods that can be used to estimate the standalone selling price. There can be an adjusted market assessment approach, which is an estimation of the price that customers in the market are willing to pay. This could involve referring to competitors' prices for similar goods or services and adjusting for entities' costs and margins. Then we could also use the expected cost plus margin approach. This is the expected cost of satisfying a performance obligation, and then we'll add an appropriate margin. And then the last approach is the residual approach. This is where the total transaction price minus the sum of the observable standalone selling price will be used to estimate the standalone selling price. And we'll go through an example for each one of these just now. So let's have a look at the expected cost plus margin. So here we have a company, Hustle. They entered into a contract with Mr. Panda to provide 3 products, A, B, and C. The total value of the contract was 250,000. Hustle usually sells product C for 120,000. Product A and B will be sold for the first time by Hustle. Product A and B were bought for 120,000 and 20,000 respectively. Hustle anticipates to apply a margin of 10% and 20% respectively to each product. So the required says calculate and discuss how the transaction price will be allocated. So we have 3 separate performance obligations in the contract. So the performance obligations are A, B, and C. So product C is the only product that has a standalone selling price based on a directly observable price. So this was given to us in the question of 120,000. The standalone selling price for products A and B, these need to be estimated. So the expected cost plus margin approach is going to be used to estimate the standalone selling price for product A and B. So you can see that product A had a cost of 120,000, and they told us in the scenario that Hustle anticipates to apply a margin of 10% and 20% respectively. So the margin for product A is going to be 10% and the margin for product B is going to be 20%. So we're going to take the cost of product A, which is 120,000, and we're going to increase it by the margin to determine the standalone selling price. So once we take the cost of 120,000 and increase it by the 10% margin, that is going to give us a standalone selling price of 132,000. Then we're going to take product B. So product B had a cost of 20,000 and an appropriate margin for product B was 20%. So that will give us a standalone selling price of 24,000, okay? The calculation to work out the margin is here. We are simply taking the cost and we are adding the margin to it to work out the standalone selling price. Once we add product A and B, and product C, that will give us a total of the standalone selling prices of 276,000. Now we need to use that to allocate the transaction price, okay? So the total transaction price is 250,000. So we are going to take the standalone selling price for product A of 132,000. That is the standalone selling price. And we are going to divide that by the total standalone selling price of 276,000. And then we're going to use that ratio of standalone selling price for product A to total standalone selling price to allocate the transaction price of 250,000. So once you do that, we'll get a transaction price for product A of 119,565 Rand. Then for product B, so product B has a standalone selling price of 24,000, and we're going to take that and work out what is the ratio of that standalone selling price to the total standalone selling price of 276,000, and we're going to multiply that by the transaction price of 250,000, and that will give us an allocation of the transaction price to product B of 21,739 Rand. Then we have product C. So remember, product C, the standalone selling price was based on directly observable prices, so we do not need to add a margin here. But here we are going to take the product C and we're going to work out what is the percentage of product C's standalone selling price to the total of the standalone selling prices of 276,000, and we're going to multiply the transaction price by that ratio to work out how much of the transaction price we should allocate to product C. And that will give us an allocation of 108,696 Rand. Okay. And then if you want to check that you've allocated it correctly, you'll add up all of the transaction price allocations and it should equal 250,000. If it doesn't equal 250,000, then you need to check something, because then it means that not all of the transaction price has been allocated. Let's have a look at this example, example 3, expected cost plus margin and residual approach. So Hustle entered into a contract with Mr. Panda to provide 3 products A, B, and C. The total value of the contract was 250,000. Hustle usually sells product C for 120,000. Product B will be sold for the first time by Hustle. Product B was bought for 20,000. Hustle anticipates to apply a margin of 20% to this product. Product A generally sells for between 100,000 and 120,000. The required says calculate and discuss how the transaction price will be allocated. So here again, we have 3 separate performance obligations in the contract. We have A, B, and C. Product C is the only product that has a standalone selling price, and it is based on directly observable prices. So the standalone selling price for product A and B, these need to be estimated. The expected cost plus margin approach can be used to estimate the standalone selling price for product B. And then the residual approach can be used to estimate the standalone selling price for product A. So the transaction price is going to be allocated in our table again. So remember, product C, the standalone selling price is based on directly observable prices and was given to us in the scenario. Product B, they told us that product B was bought for 20,000 and Hustle anticipates to apply a margin of 20% on this product. So we're going to take the cost and gross it up by the margin, and that will give us a standalone selling price of 24,000. Then product A is going to be calculated using the residual approach, which means we're going to take the total standalone selling price of 250,000, which was the value of the contract, and we're going to minus the other standalone selling prices for product C and B, and this will give us the residual, which will determine A. So 250,000 is the total, minus the 120,000, which is the standalone selling price for product C, minus the 24,000, which is the standalone selling price for product B. And that will give a standalone selling price of 106,000. Okay, so this shows us how to allocate the amounts when there is a mixture. Okay, so sometimes the standalone selling price will be given, sometimes we'll have to use expected cost plus margin approach, and then sometimes we'll have to use the residual approach. In this example, they use adjusted market assessment approach. So Albany recently introduced a new bread product line called White Quarter Loaf. It is a white quarter loaf of bread that is used to make bunny chows. This product is the first of its kind in the business. The first customer that the entity is going to enter into a contract with is Quarter King to supply 1,000 loaves of white bread. However, the business is struggling to determine the transaction price for quarter loaf. A similar product that is brown quarter loaf is sold by its competitor for R8.50 per loaf. A brown quarter loaf is generally deemed to cost 10% higher than a white quarter loaf of bread. So calculate Albany's transaction price for this contract. So here we're going to take the market value of a similar product and we're going to adjust it. So they told us that a competitor's brown quarter loaf is R8.50 per loaf. So we are going to use that to determine the price of the white quarter loaf. They told us in the scenario that the brown quarter loaf is generally deemed to cost 10% higher than a white quarter loaf of bread. So we're going to take the price of R8.50 for the brown quarter loaf, which is from a competitor, and then we're going to reduce it by 10% because the white quarter loaf costs 10% less than the brown quarter loaf. So we're going to reduce it by 10%, and that will give us an estimate of R7.73 per quarter loaf. So then, because there are 1,000 quarter loaves, we're going to take the price of R7.73 and multiply it by 1,000, and that will give us 7,730 Rand. And then this is the price, the transaction price that has been determined by using the adjusted market assessment approach. We saw a similar product in the market, but obviously we had to make an adjustment because a brown loaf and a white loaf have different ingredients and will cost a different price to make, and then will therefore cost a different price to sell. Okay. So now we need to look at allocating a discount. So identifying a discount, okay? So we need to identify if there is a discount in a question. So a discount exists if the contract price is less than the sum total standalone selling price. So the discount can be applicable to all performance obligations. If it is, we're going to deduct the discount from the total price before allocating the transaction price to the performance obligation proportionately. What happens if the discount is applicable to only some performance obligations? Then we're going to allocate the discount to the identifiable performance obligations based on the standalone selling price as a proportion of the identifiable performance obligations, okay? However, the following three criteria need to be met to do it this way. So when we allocate a discount to some performance obligations, the following three criteria need to be met. So the entity must regularly sell each distinct good or service on a standalone basis. The entity must also regularly sell on a standalone basis a bundle of some of these distinct goods or services at a discount to the individual standalone selling prices of the goods or services in each bundle. And the discount attributable to each bundle of goods or services must be substantially the same as the discount in the contract, okay? And an analysis of the goods or services in each bundle provides observable evidence of the performance obligations to which the entire discount in the contract belongs, okay? So these three criteria need to be met when we are allocating a discount to some performance obligations. So here we have an example for allocating a discount to all performance obligations. So it is adapted from example 1. Hustle enters into a contract with Mr. Panda to provide 3 products A, B, and C. The total value of the contract is 250,000. Hustle usually sells product C for 120,000. Product A and B will be sold for the first time by Hustle. Product A and B were bought for 120,000 and 20,000 respectively. Hustle anticipates to apply a margin of 10% and 20% respectively to each product. Calculate and discuss how the transaction price will be allocated. Okay. Okay, so here they have told us that the contract price is 250,000, and this is less than the total of the standalone selling price. Okay, so first we need to determine what is the standalone selling price. So let's have a look at product A. So they told us that product A and product B have they have a margin. So we need to work out the standalone selling price for product A and product B. So the cost of product A is 120,000, and we're going to include a margin of 10%, and that will give us a standalone selling price of 132,000. Then to work out the standalone selling price for product B costs 20,000, and we are going to include a margin of 20% to give us a standalone selling price of 24,000. And then product C has a standalone selling price of 120,000. So if we total all of those, we get a total standalone selling price of 276,000, okay? But they told us in the scenario that the contract price is 250,000. So we can see that the contract price of 250,000 is less than the total of the standalone selling prices of 276,000. So this indicates a discount. So the discount is automatically going to be allocated to all standalone selling prices. And that's fine for this example because all of these, because the discount is going to be allocated to all of these performance obligations. Okay, so by just carrying on in the normal way, it results in the transaction price, which is discounted, to be allocated based on the standalone selling prices. So we're going to continue in the normal way. For product A, we're going to take the individual standalone selling price of product A, and we're going to work it out as a percentage of the total of the standalone selling prices, multiplied by the contract price of 250,000. Then for product B, the standalone selling price is 24,000 as a percentage of the total standalone selling price of 276,000. And that will give us the transaction price for product B of 21,739 Rand. Product A will be 119,565 Rand. Then for product C, the standalone selling price was 120,000. And if you work that as a percentage of the total standalone selling price, which is 276,000, and you allocate the contract price of 250,000 based on this ratio, that will give product C an allocation of the transaction price of 108,696 Rand. So you can see that when we are allocating the discount to all performance obligations, it generally follows the same process, okay? But we know there's a discount because the transaction price is 250,000, which is less than the total of the standalone selling prices of 276,000. So it appears as if there's a discount for 26,000, and this has been allocated essentially to all performance obligations. So what happens when we are allocating a discount to some performance obligations? So Hustle entered into a contract with Panda to provide 3 products A, B, and C. The total value of the contract is 250,000. Hustle usually sells product C for 120,000. Products A and B will be sold as a bundle by Hustle for 130,000. Hustle usually sells product A and B for 132,000 and 24,000 respectively. Calculate and discuss how the transaction price will be allocated. So here the transaction price needs to be allocated to all performance obligations. The total of the standalone selling price is 276,000. However, the contract price is 250,000. Therefore, there is a discount here of 26,000. The discount is, however, only applicable to product A and B because the information states both products will be sold as a bundle for 130,000. as opposed to their standalone selling price of 132,000 and 24,000. Okay, so here we're going to work out the standalone selling price, and then we're going to allocate the transaction price. But the discount will only be allocated to product A and B. So the standalone selling price was 132,000 for product A and 24,000 for product B. Product C was given to us as 120,000. Okay, so the total of the standalone selling price is 276,000, and we are allocating the transaction price, which is 250,000. And they told us that product A and B is going to be sold as a bundle for 130,000. So we are going to be allocating the transaction price of 130,000 to product A and B in proportion to their standalone selling prices. So the standalone selling price for product A was 132,000 divided by the total of the standalone selling prices for product A and B, which is 156,000, and we're going to multiply that by the transaction price of 130,000. And for product B, we're going to do the same. We're going to take the standalone selling price of 24,000 and work that out as a percentage of product A and B's total standalone selling price, which is 156,000, and then we're going to allocate 130,000 based on that ratio. So based on that allocation, the performance obligation for A will get a transaction price of 110,000 and B will have a transaction price of 20,000. Product C was not allocated the discount because it was not sold as a bundle. Product C's transaction price will be 120,000. And if at the allocation of the transaction price, you'll see it equals 250,000, which is correct because this was the contract price given in the scenario. We the transaction price in various scenarios. Now we need to have a look at step 5. We need to when or as the entity satisfies a performance. So step 5, recognize revenue when or as the entity satisfies a performance obligation. So the entity needs to identify what is the date that the performance obligations are met by the entity. So revenue is going to be recognized as control is passed. So at a point in time or over time, okay? So revenue can be recognized at a point in time, which is instantaneously. So revenue will be recognized when the performance obligations are satisfied, which at a point in time will be immediately, okay? Or they could be recognized over time. So revenue can be recognized in 2 scenarios, at a point in time or over time, depending on the type of transaction or contract we have. So at the inception of the contract, how performance obligations will be satisfied. So at the inception of the contract, a decision needs to be made how the performance obligations will be satisfied. Then there's a section on repurchase agreements that is scoped out, okay? So let's have a look at how to recognize revenue. First, let's look at when does control over an asset pass. So control over an asset is obtained when an entity or a customer can direct how the asset will be used and the ability to get most of its remaining benefits. So benefits include direct or indirect cash inflows or reduction in cash outflows. So there are 5 indicators of control. So these are things you can look out for in a scenario. So when the customer will become obliged to pay for the asset, that could indicate control. When the customer will obtain legal title over the asset, when the customer will obtain physical possession of the asset, and when the customer will obtain the significant risks and rewards of ownership. When the customer the customer accept, when will the customer acceptance occur? When will they accept control? Okay. So just remember that the definition of control of an asset, this refers to the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. So control includes the ability to prevent other entities from directing the use of and obtaining the benefits from an asset. So benefits include direct or indirect cash inflows or reductions in cash outflows. Okay, so we need to look at control of an asset. That will also help us determine when to recognize revenue. So then we have, remember we said on the previous slide that revenue can be recognized at a point in time or over time. So let's have a look first at a point in time. So a performance obligation satisfied at a point in time. So these factors can indicate when control is passed. So a company has a present right to payment for the asset. The customer has legal title to the asset. The entity has transferred physical possession of the asset. The customer has the significant risks and rewards related to the ownership of the asset, or the customer has accepted the asset. So all of these can indicate that the performance obligation is satisfied at a point in time. Then we need to look at satisfied over time. So here we are looking to see if the performance obligation is satisfied over time. So only one of the criteria need to be met. So criteria 1, the customer simultaneously receives and consumes all the benefits provided by the entity as the entity performs. So an example of this could be another supplier would not need to re-perform. It could relate to transportation services, or it could relate to transaction processing services. So for criteria 2, the entity's performance creates or enhances an asset that the customer controls as the asset is created. So this could be an example of when a customer controls work in progress, or an asset is being constructed on the customer's land. So here we'll also consider the 5 indicators of control for criteria 2. For criteria 3, entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So an example of this would be an original equipment manufactured. So here only one of the criteria needs to be met. So all of these are examples or will help us determine when the performance obligation is satisfied over time. So let's have a look at an example here of when to recognize revenue over time. So using the criteria 1 from the previous slide, remember criteria 1 said the customer simultaneously receives and consumes all the benefits provided by the entity as the entity performs. So Beancounter provides accounting services to customers. It currently has the following contracts with 2 customers. Toosly is a shop that sells quarters using 2 thick slices of bread. Beancounter entered into a contract to do monthly bookkeeping services for 12 months for Toosly. Toosly also has a case with the South African Revenue Service, or SARS. SARS claims that Toosly owes money for taxes not declared. Beancounter will consult to and represent Toosly in this case. So for each contract, discuss whether you believe Toosly receives an asset and consumes its benefits as Beancounter performs its obligations. So for the first scenario, the bookkeeper services are routine or repetitive in nature. So here, this suggests that substantial reperformance of these tasks is unnecessary if another entity were to complete Beancounter's outstanding performance obligation. So for this one, if Beancounter only provided 8 months of work in the contract, and another company was to complete the obligation for the remaining 4 months, the new entity would not need to substantively reperform the work done by the previous entity for the previous 8 months. So therefore, since the new entity would not need to substantively reperform the work done in the previous 8 months, it can be concluded that TUSLE receives and consumes the benefits as Bean Counter performs its obligations. Therefore, the performance obligation is performed over time and revenue will be recognized over time. So that was the first scenario. In the second scenario, TUSLE has a case with SARS. So SARS claims that TUSLE owes money for tax not declared. Bean Counter will consult and represent TUSLE in this case. So the consulting services and representation to SARS, this is not routine or repetitive. It is quite a unique service being given. So this suggests that substantial reperformance of these tasks will be necessary if another company were to complete Bean Counter's outstanding performance obligation. So if Bean Counter owns 2 months of the work in the contract, and then another company was to complete the obligation, the new company would need to substantially reperform the work. So it needs to start from scratch in order to understand the case. So exactly report done this must concluded that TUSLE consume the benefits as Bean Counter performs its obligations. So since the criteria is not met, and unless it meets one of the remaining 2 criteria, the performance obligation must be considered to be performed. Okay, so therefore it would be considered to be recognized at a point in time and not over time. So here we have another example looking at criteria 2. So remember, criteria 2 said the entity's performance creates or enhances an asset that the customer controls as the asset is created. So Akka is a construction company with the following 2 contracts with Resit. So Resit entered into a contract with Akka to build 10 rooms onto the existing structure in Soweto. Students will take occupation as and when each room is completed. So that is the first contract. The second contract says Resit entered into a contract where Akka will build 50 rooms over 6 months. Resit will take full occupation, legal title, and settle the full payment for the built rooms at the end of 6 months. So for each contract, discuss whether you believe the Resit gains control during the creation or enhancement of the assets as Akka performs its obligations. So looking at criteria 2, remember criteria 2 says the entity's performance creates or enhances an asset the customer controls as the asset is created. So since the rooms are built on Resit's existing structure for contract 1, so remember they entered into a contract to build 10 rooms on the existing structure in Soweto. So since the rooms are built on Resit's existing structure and students will take occupation when each room is completed, Resit does have physical possession of the assets and they'll be able to direct the use of the asset and obtain substantially all of its benefits while it is being enhanced. Therefore, Resit does have control during the creation of the assets, and the performance obligation will be classified as satisfied over time, and revenue will be recognized over time for the first contract. For the second contract, remember Resit entered into a contract with Akka to build 50 rooms over 6 months. They'll take occupation, legal title, and settle the amount at the end of 6 months. So for that contract, Resit is only required to pay for the work on completion of the construction, and they also only take physical possession at the end of the construction period. So this is when risks and rewards of ownership and legal title will transfer to Resit. At this point, Resit will have the control to direct the use of the rooms. So this suggests that Resit obtains control after the rooms are completed and not during. So therefore, it does not meet the second criteria. So in this scenario, revenue will be recognized at a point, It will be at a point in time if the other two criteria are not met, okay? So if the other two criteria are not met, revenue will be recognized at a point in time and not over time. Then we need to look at how to measure progress. So over time, we need to recognize revenue, but the problem is that we need to measure the progress so we can recognize the revenue. So we need to determine a single method or the most appropriate measure that needs to be applied consistently to similar performance obligations. So there are two methods to measure this. We can use the input method or the output method. So the input method is based on the extent of the entity's efforts in satisfying the obligations in the contract. So here we would look at costs incurred, things like hours of labor or time spent on the contract. We are looking at what the entity is inputting to measure the revenue over time. We can also use the output method. This will be based on the value of the goods transferred to a customer as a proportion of the value of the total goods needed to be transferred. For example, surveys of work performed, time spent, or units produced. So let's have a look at the first example. So here we have an example, and we're going to see how the input method is different to the output method. Akka is a construction company. It has a contract with Resit, a company that provides accommodation for UJ students to build 10 rooms on the existing structure in Soweto. Students will take occupation as and when each room is completed. The total value of the contract is 100,000 Rand, and the expected total cost is 75,000 Rand. The following information is available on 30 June 2019. 3 rooms were completed, and the total costs incurred were 25,000. Then the following information is available on 30 June 2020. 8 rooms were completed, and the total costs incurred up to 30 June were 70,000, and the expected total cost is now 80,000. So we want to show how we're going to record this using the input method, and then how we're going to record this using the output method. So let's first have a look at the input method. So here we are looking at costs incurred to date. So we are told that costs incurred to date are 25,000 and total expected costs are 75,000. The total contract value is 100,000. So we're trying to know what portion of that 100,000 can we record based on the input method. So we are going to look at what has been input so far. So far, the company has incurred costs of 25,000 over total expected costs of 75,000 Rand. So then we are going to allocate the total contract value of 100,000 based on the cost incurred to date as a percentage of the total expected costs. So we're going to take 25,000 divided by 75,000 multiplied by 100,000, and that will give us 33,333 Rand. So that is how much revenue we can record to date. So we're going to debit accounts receivable, and we're going to credit revenue from contracts with customers. Then for 2020, we are still using the input method. We are going to see how much costs have been incurred to date. So costs incurred to date are 70,000, and that is since the contract started. So that is for last year and this year. And the total expected cost is now 80,000. The total expected cost has increased from 70,000 to 80,000. The total contract value is 100,000. And total revenue to date, so total revenue to date, we can work out how much revenue should we recognize now. So we are going to take the cost incurred to date, which is 70,000, divided by the total expected cost, which is 80,000. And we're going to work out how much revenue can we recognize to date. So we're going to multiply 100,000 by that ratio of costs incurred to date over total expected costs. And that is going to give us 87,500. So the total revenue during 2020 So we're going to take that 87,500, which is total revenue since the inception of the contract, minus the revenue that was already recorded in the previous year, which is 33,333, and that is going to give us 54,167 Rand. So in 30 June 2020, we can record revenue of 54,167 Rand. So we're going to debit accounts receivable and credit revenue from contract customers. So in this scenario, in the question, they give us information for the number of rooms completed. However, because we are using the input method here, that information is irrelevant. So the question specifically asks you how to calculate revenue based on the total costs incurred, which is the input method, and not the number of units produced. So then let's have a look at the output method. Okay, so the output method here, we are going to look at the number of rooms completed. So at 30 June 2019, 3 rooms were completed, and they expected 10 rooms to be completed. So we can work out the total revenue to be recorded by taking the 100,000 Rand, which is the total contract value, multiplied by 3 over 10, which represents the number of completed rooms to date, and that will give us 30,000. So 30,000 revenue can be recognized using the output method. So they're going to debit accounts receivable with 30,000 and credit revenue from contract with customers with 30,000. And in June 2020, the number of rooms completed is now 8, but that is since the contract started. The total expected rooms to be completed is 10. So we're going to take the total contract value of 100,000 and we can allocate it based on the output, which is 8 rooms over 10 rooms. And that will give us 80,000 Rand of revenue to date. However, a portion of this was already recognized in the previous financial year. We already recognized 30,000. So we're going to say 80,000 minus 30,000, and that will give us 50,000. So 50,000 revenue will be recognized now. So debit accounts receivable with 50,000. And credit revenue from contract with customers, 50,000. So in this question, we are using the output method. So here we are ignoring information based on the total costs incurred at the end of each year. So here we are looking at the output, which is the number of rooms completed. So we are not concerned with the information they have given us about the total costs. Okay. So now continuing with step 5, we have looked at how to record revenue at a point in time or over time. Now we need to look at warranties. So should a warranty be accounted for as a separate performance obligation? So there are 2 types of warranties: an assurance type warranty, which is not a distinct service, and a service type warranty, which is a distinct service. So assurance type warranties, this is not a separate performance obligation. So the entity provides the customer with the promise that the product will function as intended. So this kind of warranty will be accounted for using provisions, which is IAS 37. This will not be accounted for under IFRS 15. So remember, okay, what is a warranty? So a warranty is a promise made by the entity, usually to repair or replace a defective good that has been purchased by a customer within a stipulated time. So a warranty, an assurance type warranty, this is not a separate performance obligation and will be accounted for as a provision under IAS 37. Then we have a service type warranty. A service type warranty is a distinct service. This is a separate performance obligation. The customer has the option to buy the warranty separately. This is accounted for as revenue under IFRS 15. So this is like a maintenance plan. When you buy a car and you pay extra for a maintenance plan, that maintenance plan would be recognized under revenue under IFRS 15. So warranty is required by law. So factors to consider to identify the type of warranty. So where a warranty is required by law and is not a performance obligation, this is an assurance type warranty. So you can also look at the length of the warranty coverage. If it's a short period, this is likely going to be an assurance type warranty. If it is a longer period, then it will more likely be a service type warranty. So the nature of the tasks that the company promises to perform, you can also look at that when considering what type of warranty it is. So here we have an example for warranties. So NACRO sold a generator to a customer for 80,000. The sale and contract price includes 2 warranties. A 1-year warranty that the product will work as intended, and a 2-year extended warranty. After the warranty mentioned above lapses, the warranty states that NACRO promises to fix the product during this period where needed. So the extended warranty is available separately for 5,000 Rand, and the extended warranty is excluded from the 80,000. So discuss how this transaction should be accounted for at the inception of the contract. You are required to include journal entries. So we have 2 different warranties here, a 1-year warranty and a 2-year warranty. So the 1-year warranty states that the generator will work as promised for the first year. Therefore, this is an assurance type warranty. And remember that an assurance type warranty is accounted for under IAS 37. So IAS 37 will be applied to the 1-year warranty. Then we have the extended 2-year warranty. So this warranty is available separately for 5,000 Rand, and it offers the customer a service to fix the generator when needed during the 2-year period. Therefore, this is deemed to be a service type warranty. So the service type warranty will be accounted for under IFRS 15. So therefore, there are 2 performance obligations in this contract, okay? So remember, the assurance type warranty is not a performance obligation, but the service type warranty is a performance obligation, as well as the sale of the generator will be another performance obligation. So there are 2 performance obligations in this contract. Sale of generator for 80,000 and the service type warranty of 5,000. Both of these performance obligations total 85,000 Rand, and they can be recorded using the following journals. So we're going to debit accounts receivable with 85,000, and we are going to create a contract liability for 5,000. The 5,000 Rand is for the 2-year extended warranty, and then we're going to we're going to create a sale of goods, contract price less 2-year extended warranty. So once we take out the 2-year warranty, we're recording that warranty separately. Then we are recording the sale of goods for 80,000. Okay. So we have recorded the 2 performance obligations, being the sale of the 2-year extended warranty and the sale of the generator. And the assurance type warranty, that is accounted for under IAS 37. So that is not recorded here under IFRS 15. Okay, so that is warranties. Now we need to look at a situation where we may have a principal and an agent. Okay, so we can have a situation. Okay, so they're asking why is it a contract liability? Okay, so that's a good question. Bonnie has asked, why is it a contract liability, the extended warranty? So that is a good question. So they are basically promising or obligating themselves to fix the generator as and when needed during the 2-year period. Okay, so it's like an obligation that they have. It hasn't come about yet. They are promising that in the next 2 years, they are going to fix the generator as and when needed. So because it is, they have committed to this obligation, now, but it's only going to be, the service is only going to be rendered in the future, that makes it a liability. It's going to result in outflows. So if you look at the definition of a liability, you'll see that this extended warranty meets the definition of a liability. So it's going to result in future economic benefits flowing out of the company. It's like a present obligation, that type of thing. Okay, so that's a very good question. So the 2-year extended warranty meets the definition of a liability. Okay, thanks, Bonnie. Okay, so that is warranties. Let's now have a look at principal versus agent considerations. So here we have a principal and an agent. So sometimes an agent will act for a principal, and we need to know how to account for revenue under these scenarios. So think about a scenario where you have a room to rent and you hire an estate agent to rent that room out for you. So you will be the principal in that scenario, and the estate agent would be the agent. Okay, so we need to look at how to record revenue under a scenario like that. So if an entity is collecting a consideration on behalf of a third party, the entity cannot recognize that as revenue. That amount is a liability, okay? So here we have a diagram of a principal and an agent. So the principal here is an entity that has control over the goods or services until they are transferred to the customer and is obligated to provide the promised goods or services to the customer. Then we have an agent. An agent does not obtain control over the goods or services before the customer, but is responsible for arranging for the principal to transfer the goods or services to the customer. Okay, so think about the example. You have a room to rent. You will be the principal. If you hire an agent to help you, but you will still have to, you're still responsible for allowing the room to be rented and giving access to the room. So the estate agent would be the agent in that scenario, and you would be the principal. Okay, so the principal will hire the agent to help them, and then the agent will perform on behalf of the principal. Okay. So that is the agent-principal relationship. And we need to know when we are recognizing revenue, if we have a principal or if we have an agent, because this will determine or influence how revenue is going to be recognized. So for a principal, revenue is going to be recognized at the gross amount, including any commission payable to the agent. Any commission payable to the agent is going to be recognized as a separate expense. Okay, so that is how revenue will be recognized for the principal. For the agent, so we need to know how to identify the agent. So first of all, the agent will recognize revenue. They will only recognize commission receivable from the principal, okay? So an agent will recognize the commission they receive from the principal. How do we identify an agent? We need to look at the nature of the entity's promise to see if a performance obligation exists. So we want to know, is this person an agent? Are they a principal? Okay. So if we think they are an agent, you should see some of the following characteristics. The entity is not responsible for fulfilling the contract. The entity does not carry the risk associated with the inventory or the credit risk of the amount receivable from the customer. The entity does not have discretion in establishing the selling price of the goods, and commission is quoted in the agreement. Okay, so if these things may indicate that there's an agent. Okay, and like I said, the agent will recognize commission receivable from the principal. Here we have a scenario. A letting agent collects revenue on behalf of a landlord. The agency charges commission of 5% on the monthly rental. The monthly rental for June 2020 was 10,000 Rand. It was paid on 5 July and subsequently paid over to the landlord on the same day. The rent is paid to the letting agent by the tenants. The agent then pays it over to the landlord. So we need to know how to journalize these transactions and discuss how they should be accounted for in the financial statements of the letting agent and the principal. So let's first have a look at the letting agent. So they told us that the letting agent collects rent on behalf of the landlord, and the agency charges commission of 5% on the monthly rental. So rent was due, rent of 10,000 Rand was due at the end of June, and it was paid on 5 July. So here in the letting agent's books, that 10,000 Rand is not revenue in their books because they are acting as an agent on behalf of the principal. So they are going to show that that 10,000 Rand received is going to be paid over, or most of it is paid over to the principal. So we are going to show debit accounts receivable, 10,000 Rand, okay? They have received this asset of 10,000 Rand, okay? 5% of this is going to be commission that the agent is charging on this monthly rental. So 5% of the 10,000 Rand is going to be revenue that the agent can recognize. So we are crediting revenue of 500 Rand. That is the commission that the agent is going to record. Then they are crediting accounts payable with 9,500 Rand. So this is the amount the agent has collected on behalf of the principal, and they are going to pay this 9,500 Rand over to the principal. Okay, so they're acting on behalf of the principal. They are an agent. That would be the journal at 30 June 2020. On 5th July, here the rent is received. In the previous journal, rent was owing, so we debited accounts receivable. So here we are showing that the rent has been received from the tenant and paid to the agent. So debit bank 10,000 Rand, and then we are crediting accounts receivable. That rent was owing to us by the tenant, but now they have paid. So the 10,000 Rand is the amount that the tenant has paid to the agent. So therefore, we are reducing that accounts receivable that was initially raised. Then we are going to show that we are paying the 9,500 Rand over. The agent collected the rent on behalf of the principal, and now they need to pay the amount over to the principal. They are keeping the 500 Rand commission, which was revenue, and they are now paying over the 9,500 Rand to the principal. So we are debiting accounts payable. We had a liability to show we owed the principal money, but now we are getting rid of that liability because we are actually paying that amount. So we are debiting accounts payable 9,500 Rand, and we are crediting bank 9,500 Rand. That is the payment of rental received. Okay, so this is from the letting agent's perspective. Let's have a look from the landlord's perspective. So the landlord is the principal. So the landlord has control over the property that they are renting out. The landlord should recognize rental revenue of 100%. So they can record the full amount of 10,000 as revenue, and they're going to show the commission or the collection expense of 5%. So at 30 June, the rent hasn't been paid yet, okay, but it is due. At 30 June, they are going to say debit accounts receivable. They are recording a data to say that this money is owed to them by the agent. And they can record this full amount as revenue. So they are crediting revenue with 10,000 Rand. The landlord is owed rental revenue of 10,000 Rand. And they are including the revenue at the gross amount. Then they are showing that they owe the agent commission. So they are debiting commission expense, and they are crediting accounts payable with 500 Rand. This is the amount payable by the landlord to the agent. So this is the amount payable by the principal to the agent. Then on 5th July, when the actual money is going to be paid, we are debiting bank with 9,500 Rand. The principal has received the money owed by the agent, and they are showing the 500 Rand that they need to pay to the agent. So they are debiting accounts payable 500 Rand, and they are crediting accounts receivable to show that they were owed this money and now they have received it. So they are crediting accounts receivable with 10,000 Rand. So they are recognizing the amount received from the agent and the derecognition of the amount accounts receivable and payable. Okay, so you can see here that the principal is recording revenue at the gross amount, and then they are showing the amount that they owe to the agent as an expense of 500 Rand. So that is when you have a principal and an agent. So let's now have a look at presentation and disclosure. So we have looked at step 4 and step 5. Now we need to see how to present and disclose revenue in the financial statements. So when we look at presentation, what line items are going to be affected in the financial statements? So in the statements of comprehensive income, we'll have a line item revenue that will be affected by IFRS 15. And in the statement of financial position, we'll need to show where we have accounts receivable, a contract asset, or a contract liability. So receivables must be disclosed separately from contract assets. So even though an accounts receivable and a contract asset, they are both assets, they need to be disclosed separately, okay, based on IFRS 15. So what is a contract asset and how is it different to a receivable? A contract asset is a conditional right. It is a cancelable contract. So the contract asset is dependent on some kind of right. It is cancelable. Whereas a receivable or accounts receivable, this is an unconditional right. It is a non-cancelable contract. So, and just remember, the passage of time is not considered a condition because it is inevitable. Okay. So the contract asset, you cannot say that an asset is a contract asset because it is conditional on a passage of time, because the passage of time is inevitable. Okay, so we'll have a look and see, is there a conditional right? Is the contract cancelable? Then we'll record it as a contract asset. Do we have an unconditional right, a non-cancelable contract? Then we'll record it as accounts receivable. The passage of time is not considered a condition. So the difference between a contract asset and accounts receivable, we have mentioned this. So a contract asset is conditional upon or dependent on something happening other than the passage of time, conditional upon the future performance of the entity. An accounts receivable, the right is unconditional here. The entity will have satisfied all obligations and are now simply waiting for the customer to pay. So that is how you will determine if it is a contract asset or an accounts receivable. So then we also could have a contract liability, and this ties into Bonnie's question earlier. So a contract liability results as a credit when a journal entry is processed. So this is when an entity has not met its performance obligations. So in that previous scenario, there was a warranty that was going to result in revenue being met over time. So when we were recording that transaction, it was a contract liability because the performance obligation relating to the maintenance of the generator had not been performed yet. Okay, so the contract liability will be recorded when an entity has not met its performance obligations. Therefore, revenue cannot be recognized. So the conditions to recognize a contract liability: the consideration should be received in advance and the performance obligation has not been satisfied yet, or the entity has an unconditional right to receive the consideration. Okay, so the journals for these, under these two scenarios, where we have a consideration received in advance and the performance obligation has not been satisfied or met, here we are going to debit bank and credit contract liability. Then under the second one, the entity has an unconditional right to receive the consideration. Here we are going to debit accounts receivable and we are going to credit contract liability. You cannot yet credit revenue in these scenarios because the performance obligation has not been satisfied yet in either of these scenarios. Okay, so that is a contract liability. So for a contract liability, where we are saying the entity has an unconditional right to receive the consideration, where would an unconditional right to consideration arise before meeting a performance obligation? So this will arise when the contract is non-cancelable, okay? So if an entity signs a non-cancelable contract, the date on which the customer is required to make payment, this is the date on which the entity gets an unconditional right to the amount, even if the performance obligation is not performed. When is the due date for payment? This is not normally relevant. In other words, it is irrelevant when accounting for revenue. However, the date is important if the contract is non-cancelable because it is the date on which the entity obtains an unconditional right to receive the consideration. Okay, so let's have a look at disclosure. So then when we're looking at disclosure, we want to make sure that there is enough disclosure for the user of financial statements to assess the nature, amount, timing, and uncertainty of revenue and cash flows from contracts with customers. So there's going to be qualitative and quantitative information that needs to be disclosed about the contracts with the customers, about significant judgments, and assets recognized relating to cost to obtain and fulfill the contract. Okay, so even though significant judgments and assets recognized relating to cost to obtain and fulfill the contract, these are out of scope, it's important to know, that they should be disclosed. So the disclosure is going to affect revenue, contract assets, contract liabilities, accounts receivables, and possibly impairment losses. All of these need to be disclosed separately. So it's important to note that revenue from contracts with customers must be disclosed separately from revenue with other sources. Impairment losses relating to contracts with customers, these must be disclosed separately from impairment losses from other types of contracts. So the disclosure of revenue needs to be disaggregated, showing as much detail as possible. So disaggregated revenue, so the definition of this is showing separate revenue in different categories that are relevant to an entity. So example, type of good or service. So we want to disaggregate revenue, and if there are separate geographical regions, we want to show the revenue per geographical region separately. Maybe there is a different market or different type of customer. We want to show revenue as disaggregated and as detailed as possible. We also want to disaggregate revenue into a different contract type. Maybe there are fixed price contracts and variable price contracts. We also want to show the different contract durations and the different sales channels. Maybe some customers are wholesale and some are retail. We also want to show disclosure of contract balances. We'll need to show the opening and closing balances of receivables, contract assets, contract liabilities. We also want to show revenue recognized in the current year that was included in the contract liability opening balance and relating to performance obligations that were met in previous periods. We also want to disclose certain things relating to performance obligations. We will disclose a description of the following: when the performance obligations are normally satisfied, significant payment terms, the nature of the goods or services that the entity is obliged to transfer, and highlighting any obligation that the entity will be performing as an agent. They'll also want to disclose any obligations for returns, refunds, or similar items. And then also disclosure about warranty obligations is important. So here we have an example of a disclosure note to the financial statements. So here under 1, it's important to show the heading, company name, and financial year in the notes. So that's always for like half a mark in a test or exam. Then we also want to show comparatives if they are requested, okay? In the real world, in financial statements, there will always be comparatives in the annual or integrated report. So the financial statements need to include information about the current year and the prior year. Current year will usually be on the left and the prior year in the right. Then there's also going to be revenue totals. So this amount here will equal the number shown on the face of the statement of comprehensive income. So the revenue from customer contracts is what relates to IFRS 15. Okay. So that's just showing detail here, saying that the total in the revenue note needs to agree to the total in the statement of comprehensive income. And then in this note, you can see that they have disaggregated revenue. The information is separated into revenue from customer contracts, and it is shown geographically. They have split the revenue in the scenario between South Africa and Asia. And then you can see they also have different product lines. They have sale of hose pipes and sale of toys. Okay. So that is the disclosure, the note disclosure. Now we have important definitions which you can go through in your own time. If you're struggling with the section, you must go through the material as well from last week. So in these slides, we just define the contract asset, the contract liability, the customer and income. And then there's also a definition for performance obligation, revenue, standalone selling price, and the transaction price. Okay. And then some abbreviations, if you're going through the slides and maybe you're unsure of what the abbreviation is, if you see ATW, that is an assurance type warranty. FS is financial statements. PO is performance obligations. And SASP or SSP is standalone selling price. STW is service type warranty. And then TP is transaction price. Okay. So how will this unit be tested? There will be discussion questions, there will be calculations, there will be journal entries, and there will be presentation and disclosure questions. Okay. So this is an important topic. All the topics are important for accounting. There's a question on the group. Will this content be part of test 2? So the first part of revenue will be included in test 2, okay? So this second part will be in your exams, but the lecture you had before test 1, that will be in test 2, okay? That is mostly revision of what you did last year. And then this unit won't be tested in test 2, but it will be included in the exam, okay? And there's a question on consultations. There is someone consulting tomorrow, and I can't remember if they consult on a Monday, but you can just check the consultation times on ULink, and during those consultation times, there will be someone available. Okay, so if it shows consultation on Monday, then yes, they will be available. If not, you can consult tomorrow and whatever other times they have on ULink. Okay. That is it from me, guys. I'm just going to stop the recording. Okay, so that is it from me, guys.